Today I'm sitting down with Mark Burgess, Chairman of the Advisory Board at Jamieson Coote Bonds and one of Australia's leading investment management minds. Mark, thanks for joining me today. So let's kick things off by exploring your thoughts for navigating the current economic recovery. Maybe can you take us through how the current market compares to previous economic cycles and maybe touch on some of the important considerations that investors should be thinking about?
You know, it's a really unique recovery because we've seen one of the most dramatic interventions in markets probably in the history of markets. In fact, to the credit of central banks, to the fiscal and governments, they took immediate action last year. But now we're beginning to see the consequences of that. Will it take traction in the economy? How will the virus develop? These are really critical issues which are raising serious kind of question marks about the style and nature of the recovery. That said, financial markets are looking through that. Financial markets are looking at some of the beneficial aspects of low rates, at the rising liquidity aspect of central bank intervention. And so we've got this combination of an equity and an economic environment which is relatively unclear relative to the the financial markets which are taking a forward-looking view.
Well, it's a funny old world, Mark. Inflation rhetoric's on the rise again, and that's been a point of heated conversation both with our clients and within the team at JCB. The inflation beast has been tamed in recent years, but as we know, that has the potential to change, particularly with a stimulus-induced recovery. So is the risk of inflation real, and how should investors be responding?
Yeah, whenever I get asked a question about inflation, I'm always reminded of what I think is the right approach to thinking about risk, which is think about a range of scenarios, economic growth, for example. But inflation should be one of those scenarios. How does inflation play out? Is it a rising risk? From my perspective, we're likely to get an uptick in inflation as the year-on-year comparisons turn positive. And there are also a couple of factors that have helped keep inflation low in the past, such as globalisation, that appear to be changing. And so the ability to keep inflation at low levels perhaps is changing at the margin. On the flip side to that, though, we have very slack labour markets. We have an output gap that's quite wide. And also at these low interest rates, capacity can be added quite quickly across the world. And so, my expectation is that perhaps inflation will uptick, but we're unlikely to get the kind of embedded inflation or serious inflation that we saw, say, in the 1970s, but you should certainly run it through the portfolio. And by that, I'd also say that if you're looking at your portfolio, competition caused by excess investment due to low interest rates could cause deflation in parts of your portfolio. So you've got to run the inflation-deflation combination still when you're assessing the assets that go into a good, well-diversified portfolio.
So if we think bigger picture now, in recent years, central banks globally have coordinated to drive interest rates to record low levels. And it's likely that rates will stay low for the foreseeable future. And as a result, investors are starting to rethink how they construct their fixed income allocations. In this environment, Mark, how can investors continue to generate the required yield from their portfolios without compromising on aspects like liquidity, defensiveness, and diversification?
Yields are going to be low generally, and I think we should just accept that from the start in a broad band. Most importantly, don't chase yield for yield's sake. If you're chasing yield with risk attached to it, those risks, if anything, are probably lurking in the background more over the next 2 to 3 years than they have in the past. What we are seeing, of course, is bond yields are marginally moving back up as they're getting ready to be a defensive asset again. And so we're seeing this combination where yield is becoming available in some places, and in other places there's certainly a lot of competition for yield. But be careful because risk attached to yield is probably the most important thing to watch out for. And that's why we've always been a fan of separating, for example, corporate credit from govies. Govies give you huge safety. Corporate credits will have other characteristics. And as we come out of the COVID environment, we'll find out which corporates really are safe and which are in good shape. And we're yet to see that part of this aspect of the cycle play out.
Okay, Mark, I just want to drill in on one of the key metrics when thinking about bonds, namely duration. Can you give us your thoughts on the role of duration in the current environment? And can you take us through your thoughts around the role of high-grade government bonds and whether they can continue to diversify some of the unknown risks that remain?
Yeah, look, I think government bonds were defensive in the downturn. And I think we need to remember that. They played the aspect in the portfolio that they've always played. And as we look forward, particularly as government bonds slightly edge higher again and begin to act as another defensive characteristic, they will have a role to play. And I think any portfolio that doesn't consider government bonds is kind of missing a key component of diversification within the portfolio. So we think that they remain defensive, they will always be a good asset to have, and generally speaking, investors haven't held a large position in government bonds, and probably a lesson from last year was that it proved its diversification characteristics at a time where diversification is difficult to find. There are a couple of other places to find diversification, but government bonds are certainly one component of that.